Good morning. It is Wednesday, the 25th of October, 11:40 a.m. Pacific time. Today I want to just show you that it's not all glamorous, that you can lose in the market, you can lose big in the market. I'm sure you already know that, but I think some people fail to realize that when they see success or they see, a certain life or lifestyle, but there's a lot of ups and downs. You get bruises along the way. So I'm no, excuse me, I'm no exception. So I made a lot of adjustments today, and so I'll explain those. So if you notice, the Nasdaq down here is down over 2%. Usually, anything that moves by 1% or more is kind of a strong thing. So 2% is a really strong move on an index. Okay, so you see here 2.3%. This is 2.36% on the Qs. The QQQ, as some of my other videos have mentioned, is an ETF. It's an ETF that follows the Nasdaq. So it's not going to be exactly the same calculation, but it's fairly close. Okay. So you see all of these are zeros. These are zeros. Why are they even here if I don't have any of these positions? Well, I did have these positions earlier this morning, but I exited them. So tomorrow, this will all vanish. So you look at these dates. Today's date of expiration, and all of these are tomorrow's expiration date. So we had a big drop in the Nasdaq, in the Qs. Okay, so it dropped 847. Currently, it's at 350.66. So what does that mean for me? Well, you look at all these positions. All of these are put options. That's what the P stands for. Put options increase in value when the market drops. They shrink in value when the market goes up. If the market goes sideways, they also shrink in value because there's time decay. So options are comprised of time value and intrinsic value. So what's intrinsic value? Intrinsic value is the difference between the strike price and how far in the money the stock is, or the option is relative to the stock. So anything below 354, let me rephrase that. If the underlying stock goes below 354, this option is considered in the money. Someone who owns this option has the right to sell QQQ at 354 and then purchase it back at 350 and make that difference. They have a contract. They have the right or the option to do so. If you look at these, all of these are in the money. 352, whoever bought this put has the right to sell QQQ for $352 a share, which is more than 350.66. Same with these. They have the right to sell at the strike price. Now, that's good for them. That's bad for me. I was going to be obligated to buy QQQ at these prices, even though it's going for this. It's like if you go to a steakhouse and there's a steak for $75, but they make you pay $100. Well, that doesn't seem fair, right? Well, that's what I signed up for when I sold these options. Okay. More often than not, they'll work out for me, but sometimes they don't. So you see here, this is the net change. So this is the current value, $3.46. It jumped $3.01 today. So it jumped by a huge percentage. Okay. All of these that are the current value, look how much it jumped today. Imagine what it was worth yesterday. It was worth peanuts yesterday. So I was expecting or anticipating these to expire worthless and I win, but I didn't win, not yet at least. So what I did was I bought all of these back at a loss, and all of this information's missing because I don't have any positions. Anyway, I bought all of these back for a loss. So what I did was the money that I did collect from these options up front, I used that plus more money to buy these back. Okay, I bought these at a loss. Where did I get the extra money from? Not necessarily from my account, the cash on the side. I used market money. I used other monies to do that. Okay, so basically I bought these back and replaced them with new options that expire further in the future. So let me scroll down. If you see, there's more zeros here because I actually adjusted these call options and I bought these back for less than I sold them for, meaning I profited on these and then I sold new options, which I sold these, and this is how much I collected so far. I have 2 days left, Friday and today's Wednesday, before these expire. If these expire worthless, all of this will be mine. Right here, I'm highlighting this, 82.28, which is the same as here. That's the current amount that is a floating profit for me. If I were to exit right now, I'd have to buy them back, all these 29 positions, for a total of $24.50 and 50 cents, plus commission and fees. You can never forget those. That's how the brokers make money. And the difference between the two would be roughly $82.28. Okay, so if you look down here, you'll see a lot of red. Red is not good, right? On another video, we talked about red is bad and green is good. Well, on this side, red is bad and green is good. On this side, it depends. So because I'm an option writer, option seller, you'll notice all of these have negative signs. That means I sold these. Other videos have mentioned this. It always is good to repeat and remember, if it does not have a minus sign, then you bought them. If it has a minus sign, you sold them. And what I mean by sold them is sold them to enter or to open the position. How do I get out of the position? I have to buy them back or let them expire. Okay, so sometimes I buy them back for a loss. Sometimes I buy them back for a profit. So you see these here, 351, 352. I'm sorry. Yeah, 351, 352. These are put options that expire on Friday. These are put options that expire on Monday. These expire on Wednesday, which happens to be my 50th birthday. So happy early birthday to me in 1 week. Hopefully I'll be profitable on that day and maybe a couple of days leading up to it. Look at this one. This is huge. Negative 1,500 and something percent. So this is what I collected up front, not much, and this is how much I would have to buy them back for if I were to buy them back and exit the position. So it is possible to lose more than you started with, okay? Now, if you see these numbers here, these dollar figures here, these dollar figures, okay, straddle and strangle, we'll have to go over that in another conversation or another video. But these dollar amounts are monies that are in my account that's tied up that I have to have up front in order to use this strategy. So you see this 11,321 and 80 cents. That was what is required to sell options, these options in particular, and collect $538.68. That sounds like, whoa, what a low return. So let's see, 1% of this is about $113. So this is between 4 and 5% of this. Now, why would I do that? Well, the probability of winning is higher doing this, even though I'm losing right now. And look at the expiration date. It's coming up in a couple of days. So if I do this maybe a couple of weeks out and I pick up 4 or 5%, that comes out to 8, 9, 10% in a month. If you do that and you compound it, it can really add up. So that's why I do it. But I don't always win, as you can see, and I just want to show you the good, bad, and ugly, so you know the reality of it. So, keep in mind these numbers here, 354 and lower on the puts. That means I want the market on the Qs to stay above 354, and I'd like it to stay below 357. Let me scroll back up here. It's at 350. So that means these positions here are in the money. That's not good for me. That's good for the person who bought these. So I'm going to go ahead and roll these. I'll go ahead and I'm going to roll this one just because this is annoying. So I'll do that right now. The symbol's the Qs. It defaults to put because it's a put option. I'm going to go here to roll out. I'm going to buy to close. When you have positions, it automatically gives you this, I don't say pop-up, but this selection here. And I'm going to sell to open 6 new positions. So we're closing these out. So these will disappear. I'm selling new ones to open. So because I'm selling new ones to open, I'd like to get a net credit. So I don't want to buy these on my own dime. I want to use the market's money. So you see this 349.82. This is now in the money. And so I can wait, but as an example, I'll do it. Because this can easily, it's right basically at the money. I can easily see this pop back up. We have Meta earnings this afternoon, my time, after the market closes. And if Meta has positive earnings and a positive response to that, then the Qs can pop back up, because Meta, which used to be Facebook, is part of the NASDAQ, part of the Qs. Okay. But anyway, we'll do this trade anyway. So this strike price is 349. That's out of the money. That's below this. See, look, now this one is slightly out of the money, but it's it's kind of on the fence. Okay, let me refresh this. Okay, I may go out further in time. Time is money. The more time between now and expiration, the more on the same strike price, the more premium, the more value it's going to have. Okay, so now you see the CR, that's a credit. So I'm adding 4 more days, 4 more calendar days until expiration. I'm actually on the fence, but I promised I would do it. And now what's the downside? The downside is I have to wait 4 more days in order for this option to expire. But at least in the meantime, I squeeze out maybe another $100 or so. Not a lot, but it's a little bit more than I originally collected, and it's now out of the money. So I'm slightly out of harm's way, but I might have to roll again in the future. We'll see. Okay, I'm going to go ahead and place this order. And let's look at the order status. to see what happened. Okay, so we are filled. Okay, we got filled at 19 cents. So that's what we saw. It's $114. So I have to hold on to this now until November 4th, and or I can buy it back earlier. But it's now out of the money, and that negative 1,500 percentage is not staring me in the face. So I potentially turned a losing trade into a winning trade. Thank you for watching, and have a wonderful afternoon. Be sure to like and subscribe. I will be posting more videos again very soon.